Okay, hi there, welcome to another policy focus video. This is the second in a little double on the impact of minimum wages. In a previous video we thought about how a minimum wage could impact on unemployment. In this video we asked the question, to what extent might a higher minimum wage cause an increase in the percentage rate of inflation? So here's the question. Let's start by defining inflation. Inflation, of course, is a sustained increase in a country's general price level. On average, the price of goods and services are going up over time, and that means the internal power of money goes down, the real value or purchasing power of money falls. So why might a higher minimum wage, a pay floor in the labour market, why might it cause inflation? Here are one or two analytical points explaining the possible causal connections. First of all, it's important to make the link between minimum wages and labour costs. So a higher minimum wage will, other factors remaining the same, lead to an increase in the labour costs for many businesses, including businesses that employ a lot of labour, businesses in tourism and retail and hospitality, and especially things like health and social care. Many businesses will then opt to pass on these higher costs by raising their prices to the final consumers. And that's going to lead to a direct increase in the consumer price index, which of course is the main way we measure inflation. So in this sense, an increase in the minimum wage could cause what we call cost push inflation. And actually, there's also a secondary effect possible, in the sense other workers who are paid maybe just above the minimum wage and whose pay differentials might have just got squeezed or narrowed, they too may bargain with their employers for a pay rise. So there's a risk of quite a pickup in wage inflation, which can then feed through to general price inflation. A related point worth adding into the analysis is that if a minimum wage drives aggregate demand to be higher, lower income workers, for example, typically have a high propensity to spend, and if their minimum wage has gone up, they may well increase their demand for goods and services. That can also cause demand pull inflation. How can we show cost push inflation using ADAS diagrams? Well, cost push inflation is caused by any factor that leads to an inward shift of the short run aggregate supply curve. I'm using the classical model here. So let me shift the aggregate supply curve to SRS2. That's going to drive the consumer price index up from GPL1 to GPL2 and cause a contraction in real output. Shown there. Okay. Cost push inflation, of course, can also lead to lower growth and often causes a fall in real living standards, although it can prove to be temporary. Depends if it's a permanent shift. And how can we show demand pull inflation using the same analysis? So here's our initial situation again. Demand pull inflation occurs when there is a positive output gap, GDP is above potential, and where aggregate demand is rising quickly, as we see here. A big increase in AD to AD2 can drive aggregate demand and output to a level of Y2, which is above the potential output level, and increase the general price level. So in theory, a minimum wage, either through cost push or demand pull factors, can lead to an increase in inflation. However, in practice, this may not be the case. Although in theory a minimum wage can cause firms to pass on higher wages in higher prices, in practice, in reality, it's not necessarily inevitable. So here are 5 short evaluation points. Firstly, we drop the ceteris paribus assumption. So factors other than labour costs may have gone down. For example, a country's exchange rate might have appreciated, gone up in value, and that makes the cost of imports of things like raw materials, fuel, component parts, etc., that makes them cheaper. Strong pound, imports cheaper, exports dearer, and of course that can help bring down the rate of inflation even if the minimum wage has gone up. Second point, a higher minimum wage might stimulate labour productivity, which then means that unit labour costs may stay relatively the same with little risk of a surge in cost push inflation. Does a minimum wage cause inflation? Well, of course, much depends on how high is the increase. 2% pay rise, minimum wage rate is not going to cause much effect on inflation. A much bigger increase could have a sizable effect. much depends on how important are labour costs as a percentage of total costs in a firm's expenses. Another micro point which affects inflation in many competitive markets where there's fierce day-to-day competition, firms may be reluctant to pass on higher wage costs in the form of increased prices. They may choose to protect their market share, to absorb higher costs, perhaps temporarily, through lower profits. And I think the risk of demand pull inflation from a minimum wage is relatively small. First of all, the net effect is likely to be limited, and oftentimes when the economy is operating well within its production possibility frontier, it's operating with a negative output gap, I think the risk of inflation from higher aggregate demand is relatively small. So those are some of the key evaluation points to this question: to what extent might a higher minimum wage cause an increase in inflation? Thanks for joining in. Stay safe, stay curious, and see you all sometime soon.